On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning all. I wanted to talk today about currencies and share investing. I get a lot of questions about this, and I think that is because these days, pleasingly, we are much more open-minded as investors about buying companies or funds or exchange-traded funds, ETFs, all across the world. We're not nearly as insular as we used to be in our thinking, and we're very happy to have a portfolio that is spread far and wide with New Zealand stocks, but also companies in the US, Europe, Japan, emerging markets, and everywhere in between. So I wanted to talk about that because, of course, if you buy a US listed share or ETF, it's not just changes in the share price and the dividends you get that will determine your return. You also need to keep a close eye on the exchange rate between the New Zealand dollar and the US dollar. And sometimes the moves that you see between currencies can work in your favour as an investor, as has been the case this year. As an example, the S&P 500 index in the US is up 6.9% so far in 2024, which is a very healthy return when we're only just 4 months in. But in addition to that, the New Zealand dollar has fallen 6% against the greenback, the US dollar, on the back of resilient US economic indicators and stronger than expected inflation over there. So you've won on both hands if you're a Kiwi investor who's been buying US stocks. And when we account for those currency moves, the return you've got is not just the 6.9% from the market, but it jumps to 13.7% because of those currency moves. So this is an example this year with regard to the US at least. Every region's different, every currency's different. But in terms of investing in US shares from here in New Zealand, 2024 has been a very good year and your return has actually doubled because of those currency moves. Declines against the Australian dollar, the British pound and the euro have also boosted returns to local investors in those overseas markets as well. So it has been fairly across the board. Japan would be the one outlier. However, that's not always the case. There have been plenty of times through history where currency moves have proved to be a headwind, and there's even been some times when they have turned positive returns into negative ones. So it is not something that benefits you always. Historically, the Kiwi dollar does tend to perform better during periods of optimism and when the global economy is strong and robust. In the world of currencies, we're seen as a higher risk prospect, and that makes a bit of sense. Our economy is small, we're vulnerable, we're very dependent on commodity prices as well, and commodity prices can be volatile. They're very up and down, and they tend to follow optimism and the path of global economic growth too. So what that means is that when markets get nervous, investors ditch the Kiwi dollar and they flock to the safety of currencies like the US dollar, the Japanese yen, the Swiss franc, the big currencies that are simply stronger than the little old New Zealand dollar. And because of this, rising global share markets generally go hand in hand with a stronger Kiwi dollar and vice versa. So at times this has proved to be quite a useful shock absorber for New Zealand investors, such as during the global financial crisis, the GFC. If you're around in those days and if you cast your mind back, share markets were down heavily between late 2007 and early 2009 over that 18-month period. And the US share market fell much harder than the local NZX, the New Zealand share market. But that risk aversion and that nervousness also hit the Kiwi dollar. And the New Zealand dollar against the US dollar fell 40% in 12 months. It was trading at about 82 cents against the US dollar in early 2008. And by the bottom of its GFC slump, which came very close to when markets reached their bottom, it was March 2009, it had fallen from 82 cents to just under 50 cents against the US dollar. So that's a big decline, down 40%. And what that meant is that the slump in US share prices was partly offset by that big fall in the Kiwi dollar as well. So even though in local currency terms, New Zealand shares held up better than US shares, for a New Zealand investor in New Zealand dollar terms, the US market actually held up better than local shares because you had that shock absorber of the currency falling. So it can work in your favour. It was a similar story during the COVID-induced recession of 2020 when we had the lockdowns that sent the world into recession, and you had a slumping New Zealand dollar at that time that also shielded investors from the brunt of those declines. In contrast, if you look at the two recessions before that in the United States, there was one in 1990 and another in the early 2000s around the time of the dot-com boom, sort of all imploding from 2000 to 2002. During those two recessions, currency moves made a difficult situation worse. During both those periods, and we won't go into why, but during those times, the New Zealand dollar actually rose a little bit against the US dollar. So that meant returns that were already negative became more negative. So it can work for you or against you. Those are the last four US recessions that we've talked through. So the most recent one was the COVID period, then you had the GFC, then you had the dot-com crash, and then you had 1990. So those four US recessions were the times when the US share market and most global markets have found themselves in the most difficult spot. In the two most recent times, currency moves helped us as investors, but in the two times before that, they were problematic and they made a bad situation worse. So I think if you look over the last 2 decades overall, in fact I know because I ran these numbers, currency moves have actually added slightly to returns from US shares, but they have eroded returns from Europe, Japan, and the UK. So a few swings and roundabouts there. The differences aren't substantial, they're relatively small. And if you've had a globally diversified portfolio, a few wins, a few losses over that long-term period, the impact should have been fairly minimal. Something else that's worth bearing in mind as well is that most of these large international companies that we buy, whether it's Microsoft or Nestle or some big company out there in the wide world, most of these big heavyweights, they have operations right across the globe. You know, they're very much multinational in nature. So they're getting their earnings not just from the country that they're listed, but from right across the world. So if you look at the S&P 500 index in the United States and aggregate all the companies together, all the revenues, more than 40% of the combined revenues from the companies in that share market index come from outside the United States. Over 80% of the revenues for all the businesses in the UK FTSE 100 come from outside the UK. They're international. So what that means is there is a bit of a natural hedge there because a weaker US dollar or a weaker British pound, while that's problematic from a currency translation perspective because it means the Kiwi dollar is going up and that's eroding your returns, that might be partially offset by higher underlying profitability for many of those businesses because they're all exporters. And just like is the case for a Fisher & Paykel Healthcare here in New Zealand, or if you're a dairy farm, if you're a US exporter or a British exporter, a weaker US dollar, a weaker pound works in your favour. So there are definitely some swings and roundabouts there. At the moment, the New Zealand dollar is trading at about 59 cents against the US dollar, so that's below its 25-year average of 66 cents. However, it is above its long-term average against most other major currencies. We're above our long-term average against the Australian dollar, the British pound. We're about there or thereabouts against the euro, and against the Japanese yen. We're well above the long-term average. The Japanese yen has been very weak. So it depends which country you're looking at. Now, if things do revert to their long-term average, and they won't necessarily, but that is one way to think about it. Where are these currencies trading relative to where they've historically been? If they did revert to that long-term average, then again, you would experience some headwinds and some tailwinds. You might see the Kiwi dollar move closer to its long-term average against the US dollar over the course of time, and that would mean you've got a headwind in terms of returns from your US shares. You might see the opposite against the pound or the Australian dollar or even the Japanese yen. None of that's guaranteed, but that's just one way to think about it. You've had these swings and roundabouts in the past, and I think you will continue to have them in the future. So as investors, that is another moving part that we have to think about, and investing's hard enough. We've got to pick the right sector, we've got to pick the right part of the world, we've got to pick the right company or ETF, where we've got to worry about share prices going up and down. It's just another thing to worry about, isn't it? That you've also got to think about currencies and whether they're going to work in your favour. I don't think we should let that discourage us from investing in all of these great businesses that are out there across the world. Remember, over the long term, currency moves won't have a major bearing on returns. And at times they can actually help because they can actually reduce volatility. So most local investors are happy to take on some currency risk. I think about that as a bit of an insurance policy against our small, quite vulnerable, quite concentrated economy. However, if things like this are worrying you, if you don't like the idea of having to think about currencies and it's just another thing that can go up or down as well as share prices, which already go up or down, if that causes you a bit of grief, then hedging the currency is one option. And this is something that professional investors often do. People with large portfolios will often do this as well to varying degrees. And there are lots of funds and ETFs that you can use to make that achievable cheaply and quickly. That's something to talk to your advisor about. The exact level of currency hedging that you might want to apply across a portfolio is debatable. Some people might not want to be hedged at all, might want to be completely unhedged, and that's fine. Some people might want to be fully hedged so they don't have to worry about currency moves at all. For most people, typically they opt for hedging of somewhere around that 20% up to 50% of their portfolio. So everyone's different, but that is what a lot of investors land on, and that leaves them with enough unhedged international exposure to counterbalance any unexpected shock to our economy or some other event that might send the New Zealand dollar lower. So it is important that you have got that up your sleeve as well, I think, for most people. But I think the key message that I want to impart is that holding a portion of your wealth outside our shores is really important for New Zealand investors. Yes, currency movements can be annoying. Sometimes they work in your favour, sometimes they work against you. We've got to understand that, appreciate it, embrace it. But what we shouldn't do is let it put us off taking opportunities in other markets. The last thing I would like to see anyone doing is thinking, well, geez, these currency moves can be really annoying, so I'll just hunker down here in New Zealand. It feels a lot safer and a lot simpler. There are so many opportunities out there in the world, so many great businesses, that it would be very unwise for us to forego those simply on the basis of potential currency moves. So talk to your advisor if hedging or partial hedging is something that might make it more palatable for you to invest in international shares. Then we can give you some options. They'll be able to help. Otherwise, it's just something we need to accept and understand. It is part of investing, and while it can push things around in the short term, over the long term, it is far from a showstopper. All right, thanks for listening, team. We'll call it a day there, and we'll talk again soon.
For more insights, visit craigsip.com.